Ladies and gentlemen, welcome to Entrepreneurial Finance, the trade sales. How does a trade sale typically go? Well, let's look at an example first. Instagram was sold to Facebook for $1 billion US dollars. And Greylock Partners was involved, Sequoia Capital again was involved. So it was a typical trade sale. It was a cash and share deal. So Facebook paid with cash and shares, the same what they did with WhatsApp. And Instagram, because they raised approximately 50 million from Benchmark, Greylock, and all the other VCs, probably also the VCs made a lot of money in that transaction. So the trade sale is the very classic form of an exit. Actually, it's the most common form. It happens in most cases. Also, the fire sale normally, when a VC sells a business because he doesn't believe in the business anymore, is typically also a trade sale, but with the low valuation. So it's not an Instagram story. But let's look at the trade sale a little closer to understand what is the advantages, disadvantages of a trade sale. Well, first of all, the advantage is you can make more money than you can make standalone. Remember what the rationale of a strategic buyer is. And we might also say that's the rationale of Facebook, because they paid $1 billion for not many users. Why did they pay $1 billion? Well, that's in general the synergies they might have seen there. So with a trade sale, you normally have the potential to realize synergies, meaning you have a potential to realize the value in excess of the standalone value. If you think about the rationale of synergies, if you have synergies and synergies make your company worth more, maybe you can realize at least some part of the synergies in the sale price. This is why you can make some money in a trade sale. Maybe you can make more than in a standalone case with a financial acquirer. The second thing is you can easily cash out. At least it was parts was cash deal, some was share deal, but in most cases trade sales is pure cash deals. People cash out or shareholders cash out, and this is it, and no obligations afterwards. If you look at an IPO, for example, you can't cash out at closing. You can cash out maybe later on after lockup and so on, but normally that's the easiest way to cash out instantly. And you can do a relatively short execution. You can basically make the deal in a day. And then you have to do the due diligence, which again takes you probably 3 months or whatever, but you can really make the deal in a very short moment. It can be confidential. If you do an IPO, you never can be confidential because everybody gets to know all the papers of you, and you have to make marketing because you need people who buy your company, or you buy your shares. In that case, it can all remain confidential until the terms have been agreed. I mean, look at the transaction, the biggest transaction, Chrysler being bought by Daimler. Even this transaction was kept confidential, totally confidential. Also, many people were involved in that. That was really interesting to see. And if you make it a good process, and that's the last point, if you have more than one buyer involved, you can get some competitive bidding, and it's good for negotiating power. In the end, it could be good to realize even more than the synergies, even more value, even a higher price in the trade sale. So this is the advantages of a trade sale. There's always disadvantages. The first thing, the starting point is shareholder and management objectives may conflict, especially when the venture capitalist wants to sell and management doesn't want to sell. Normally, this is not happening. This is not possible because the potential buyer wants to talk to the management, and the trade sale is always fully about trust. And if he doesn't trust the management can always destroy the trust. The trade sale won't take place. So venture capitalists, if they really want to force someone to sell, they probably have to exchange the management before. Now, this is a typical conflict. There can also be a conflict in value because venture capitalists are mostly interested in the sale price. Management might be interested in an option program of the potential buyer, and maybe this is a lot sweeter than what they get in the sale price. So that can be a little conflicting there. So there's conflicts between those two parties, and those two parties really have to be in line with these things. Otherwise, this process is going to be more difficult. Having talked about synergies, and having said in the Zappos Amazon example, Amazon buying Zappos, they only need one IT. What about the IT people with Zappos? And Amazon people coming into Zappos, talking to them, talking about the IT systems. This is destabilizing the employees. Actually, the employees will notice that and will say, okay, what about my job when Amazon takes it over? And then it's very hard for the management to deal with that situation, because you have to tell them, be calm, there's no deal. Otherwise, knowing if there is a deal, you might have these people might have to go. This is destabilizing, because it's all intelligent people and they all think about these situations. And it always takes away management resources. If the trade sale is going to take place, that's good for you. If not, it took away management attention and there's no outcome of the management attention. Most important is that you deal with a good process. Actually, most important is to have someone who can do the process in a structured way. Because what you have to do, you have to analyze the initial situation before even selling the company. Thinking about synergies, for example, you have to do that long before you want to sell the company. That's part of the process of selling the company. They have to have a good documentation, an information memorandum. Think about the reason why you want to sell the company. It's not very obvious. I want to sell the company because I don't want to run that anymore. That's not a good reason. So think about a good reason. Think about something fitting to the other company. Think about the right reasoning. Turning too old to run the company anymore, if you tell that to someone, the other side will say, okay, I can wait until this company is going to be cheaper. Because getting older as a guy from a mid-sized company, it's always harder to run the company. Then identifying the right buyer, getting them to contact them, analyzing the company, getting these buyers into a right negotiation strategy, competitive bidding, and so on. There's lots of details in that process worth talking about. In general, the main tip at this stage is you have to have someone who knows how to run the process. Because what this guy, Colin Schmitz-Falkenberg, found out in his PhD thesis is, for the same company, with a good process, you can double the price. So the same company making 5 million profits with a multiple, sold with a multiple of 5 is a 25 million deal. You can sell the same company for 50 million if you do the process in the best way possible. That's in this PhD thesis the result. So it's worth looking at someone who can help you selling the company, because you can't do that by yourself.